The results of the study will then be 129 expressed in terms of CAGR, compound annual growth rate, which measures the annual growth of a particular indicator over a specific period of time. First of all, the analysis will focus on comparison with some reference benchmarks, to understand if and to what extent the results provided by the sample differ from the results recorded for companies that are not owned by private equity funds. In particular, the benchmarks taken into consideration are three macroeconomic indicators, such as national GDP and employment rate, Mediobanca Union Camera Research, which presents the annual results of Italian industrial SMEs between 2008 and 2018, and data provided by ISTAT, National Statistical Institute, which provides the economic annual results of Italian companies. Subsequently, the data collected will be used to carry out several analyses on the sample, including a comparison of targets' performance in the 3 years before and after the investment, in order to have a complete picture of the type and extent of the impact provided by private equity operators. In this way, it will also be possible to understand if this impact is significant or if similar growth rates were recorded even before the investment, therefore attributing to the operator the ability to select specific companies that record higher returns and growth rates than others, in order not to modify the previous trends of acquired companies and helping to maintain or even accelerate the performance of already growing companies. First of all, as already mentioned, it was decided to consider, through the PEM database, all the investments, not necessarily already divested, made between 2013 and 2016, in order to be able to collect all the necessary financial statements available on the IDA database before and after the investment date. The former sample is composed by 360 companies, 69% buyout, 25% growth capital, 4% turnaround and 2% replacement. For obvious statistical reasons, the analysis will mainly focus on buyouts and growth capital transactions, thus not considering the other typologies. Furthermore, for some of the transactions covered by the experiment, it was not possible to retrieve the data on the financial statements from the IDA database because of their absence or incompleteness. After necessarily excluding also large companies and secondary buyouts, the total number of companies in the sample amounts to 107. From a sectorial point of view, 33.6% of the small and medium-sized enterprises in the sample operate in the industrial products sector. Following this, with a percentage equal to 21.5% of the total, are the companies belonging to the consumer goods sector, while the third most invested sector is that relating to food and beverage with a percentage of 15.9%. Another important and deserving aspect of further study is the one relating to the amount of share capital through which the investor enters the shareholding structure of the target company. In particular, 7.5% of the sample acquired shares not exceeding 25%, 21.5% shares between 26% and 50%, 31.8% shares between 51% and 75%, lastly 39.3% shares ranging between 76% and 100%. Consistently with the types of transactions taken into consideration, i.e., buyouts and growth capital, most operations are characterized by the acquisition of a majority stake by the private equity investor. The first analysis carried out on the sample concerns the involvement of two macroeconomic indicators, namely the Italian GDP and employment rate. To make a comparison between the trends of small and medium-sized enterprises invested by private equity operators, it was decided to take into consideration the average CAGR in the 2016 to 2019 4 years time horizon, i.e., exactly the following 3 years compared to the investment date. Over the period, private equity-owned companies have continuously grown at a higher pace compared to the Italian market, both in terms of revenues and employment growth rate. In the following chart, the comparison between GDP's CAGR and PE-backed companies' revenues and EBITDA is displayed. The second macroeconomic indicator used as a benchmark for the sample refers to the employment rate. The employment growth rate trend in Italy has shown a quite flat trend over the reference period, however highlighting a slight decrease ending in 2019, about 0.4%. Over the same period, private equity-backed SMEs have always kept a higher employment growth rate, constantly about 7% above the national rate. The second benchmark to be analyzed is constituted by ISTAT data on the annual economic results of all Italian companies, hence including the ones not participated by a private equity fund. Considering only small and medium-sized enterprises, up to a maximum of 250 employees, the ISTAT data show an annual negative turnover growth rate in the 3 years time horizon, with a value of approximately -1%, while the companies owned by private equity shows, in the 3 years following the investment, a positive turnover growth rate, much higher than the reference benchmark, for a total difference of 9.87 percentage points. In terms of EBITDA, the average CAGR of the sample amounts to 11.8%, while the reference benchmark, pointed out by ISTAT in a 3 years time horizon is about 2.8%. Also, in this case the PE-backed firms have a much higher growth rate than the national average for small and medium-sized enterprises, with a difference of about 9 percentage points. The last comparison worth exploring using the data provided by ISTAT is that of the growth in the employment rate. In this case, companies invested by private equity operators, which have an average employment rate CAGR of 9.1%, exceed the benchmark provided by ISTAT by almost 8 percentage points. After comparing the data contained in the sample with those provided by the ISTAT databases, it was deemed necessary, in order to confirm these trends, to compare the sample also with further research. For this reason, the research carried out by Mediobanca and Union Camera will be used, which analyzes Italian small and medium-sized industrial enterprises, for the period that goes from 2009 to 2018. Differently from the data found by ISTAT, which however also includes small and micro enterprises, the average annual growth of revenues measured by the benchmark is positive, but in any case, much lower than the CAGR recorded in the private equity-backed companies analyzed. The difference, however, remains almost similar to that found by comparisons with other benchmarks. If we take into consideration the data on the growth of the employment rate, we see that the CAGR detected by the benchmark is significantly lower, 0.23%, for the analyzed years. The sample instead returns an employee growth rate of 9.1%. Also in this case the data collected by ISTAT and Mediobanca, Union Camera are very close to each other, and the difference with the sample is almost the same and is around 9 to 10 percentage points. Finally, the last indicator to be analyzed is that of total assets growth rate. In this case, the growth of total assets in companies owned by private equity operators is on average much higher, 14.99%, than the growth of total assets recorded in Italian medium-sized industrial companies, 1.05%, with a difference of approximately 14 percentage points. After carrying out an analysis by comparing the average data collected in the sample with those observed in the reference benchmarks, it was deemed appropriate to investigate the impact of private equity on the target companies themselves, comparing the performance trends before and after the investment. The main objective of this last step is to actually ascertain whether, as stated by some research in the literature, private equity has a significant and clearly visible impact compared to the pre-investment period, or whether private equity companies only select firms that already have high growth rates, helping only to accelerate or maintain the performance of companies that are already growing. Overall, we can observe that there is no significant difference between the pre- and post-investment averages. The only exception is constituted by the average employment 3-year CAGR, which, being subjected to the t-test, reported a significant difference for p less than 0.05. In conclusion, we can say that, on average, the compound annual growth of target firms after the investment is slightly higher than in the previous period. However, these differences are not overwhelming, except for the rate of employment growth, which is significantly higher in the subsequent period. From the empirical research proposed in Chapter 4, several conclusions can be drawn. First of all, it is important to underline how by comparing the data on Italian SMEs subject to private equity investment with the benchmarks illustrated in the introduction phase, the skills and resources provided to the target companies favor a much higher growth of the invested company compared to the average recorded by the macroeconomic indicators, ISTAT and Mediobanca Union Camera databases. In fact, as supported by provided data, companies that are subject to private equity investments have significantly higher CAGR in size and performance than non-investee companies. As we noted in the final part of the analysis, taking into consideration the total averages, we observe an improvement in growth rates in the period following the investment for all indicators except for the total asset CAGR, for which post-investment growth is slightly lower than pre-investment growth. However, the gap recorded in the two periods is not particularly significant. In fact, the biggest differences are recorded in the employment growth rate, around 3%, and in the EBITDA growth rate, around 4%. This suggests that private equity firms, on average, excluding turnaround operations, usually target small and medium-sized enterprises that already have rather high growth rates, or at least fairly above average. The only exception in which the difference between the growth rates is statistically significant is that concerning the employment rate, which is significantly higher in the period following the investment by a private equity fund. At the end of the proposed research, it is possible to affirm that, in general, the entry of a private equity fund into the share capital of a target enterprise positively influences the economic and financial performance of the investee company. This emerged both when the theoretical part was treated, and also when the empirical analysis was performed in the fourth chapter. In fact, for the company, the entry of a fund represents not only a contribution of capital but also a contribution of skills, of know-how transfer, of help in management, of exploitation of the network of contacts that the fund has. The relationship that is formed between investor and company is undoubtedly to be considered win-win, since the fund actively strives to ensure that the investee company increases its value. The more this value increases, the more the capital invested by the fund will be remunerated. Observing the studies carried out in the document produced by Frontier Economics in 2013, we can see how, at an international level, most of the research attributes to private equity firms a decidedly positive impact on target companies, supporting them by increasing the level of innovation, of productivity, internationalization, and expertise. Also in Italy, from the research analyzed, it is believed that private equity represents, for Italian companies, an option to be taken into consideration, also, in the light of an entrepreneurial system characterized for the most part by small and medium-sized enterprises, undercapitalized, family-owned, poorly managed and grappling with the challenges deriving from globalization. As regards the first objective set by the empirical analysis, the results obtained are definitely positive and confirm what has been observed in the literature. The analysis was carried out on a sample of 107 small and medium-sized Italian companies invested between 2013 and 2016.